When will the stock market's pain end? I'm going to do something really stupid right off the rip here in today's video, and I'm going to tell you that I don't know the answer to that question, believe it or not. I don't have a crystal ball, and anybody that tells you they do know the answer to that question is just flat out lying to you, and they're doing you a major disservice. In this video, what I can promise to you is that I will give you my best guess, my best analysis as to what the answer to that question might be. But to understand this, we also have to understand why the markets are selling off currently. It all started with the Atlanta Fed's GDP Now estimate for Q1's GDP growth, which absolutely cratered at the end of February and in early March to now estimating that GDP growth will be actually negative 2.4%. As of today in Q1. What the markets don't realize, and this is what's opening up an opportunity for investors like me and you watching this video, is that this is simply a timing issue. Q1's GDP growth is not going to be negative 2.4%. On the screen here is all of the inputs that go into the Atlanta Fed's GDP Now estimate model. It's household consumption, it's business investment, it's housing, it's government spending, it's net exports, which is exports minus imports, and it's change in private inventories. Net exports had a negative 3.57% impact on the Atlanta Fed's recent GDP estimate for Q1. That's because imports subtract from GDP and exports add to GDP. As businesses and corporations front-ran Trump's tariffs, it meant that our trade imbalance grew even larger. It's a short-term aberration in the data. It's an outlier, and it is not representative of weak structural economic growth. But that's what the markets are missing. You see, the flip side to the coin is while you subtract imports from GDP, it actually reflects in consumption and investment and private inventories. But we haven't gotten data yet that reflects the surge in imports. We don't have data in consumption and investment and inventories that shows this surge in imports yet, but that's coming. And when it comes, this negative print is going to be reversed because there's two sides to this coin. Now, to be fair, it's not just the surge in imports that's caused this reaction. It's also been a weak consumer. But again, this is another aberration in the data that I don't think the markets realize. You see, there's so many different data points that I could pull up for you. I'm just going to pull up Redbook retail sales data because this is the most up-to-date information we get. This isn't factored into a lot of the national data we get. This is just a smaller subset of data, so take it with a grain of salt. But during the January weeks, you'll see that here. During the January month, retail sales via Redbook data were very weak in the 4% growth year over year range. Since then, in February and in March, retail sales have been growing back into the 5% year over year, 6% year over year range, which means retail sales or consumer spending has recovered since the month of January. But again, this is data that's not yet represented in the national data that investors actually pay attention to. So you may be asking, why was January's data weak? It was weak because it was the coldest month of January we've had since 1988. When we have extreme cold temperatures, record-setting cold, people stay indoors and they don't spend as much money. They don't go out into the economy. They don't go to the movie theater. They don't go out to eat. They don't spend their money. But again, it's another short-term aberration in the data that the markets are freaking out about right now. If I can dumb it down any further, the markets right now are concerned with stagflation. An economy that's headed into recession during a time period where we have high inflation. And tariffs only threaten that high inflation going even higher, exacerbating this problem. Now, I know it's an absolute shocker that inflation has been back on the uptrend ever since the Federal Reserve first cut interest rates at the end of last year. You can see that in the chart here via the 1 month, 3 month, 6 month, and 12 month annualized numbers of CPI data. It's been on an uptrend. Shocker. Yes, I'm being sarcastic because you can go back on the channel when we talked about this, that I thought it was the wrong move for the Fed to make to cut interest rates because upwards pressures on inflation outweighed downwards pressure on inflation at the time. Now, tomorrow we get a new CPI inflation update, and I think this will actually give the markets some hope, some optimism. I think tomorrow's going to be a green day, and the rest of the week will be a very, very good week for the bulls. Knock on wood. Again, I don't have a crystal ball. This is just my best guess. The reason I think that is because for the first time since the Federal Reserve first started cutting interest rates, we're going to have lower year-over-year inflation than the month before. Via the Cleveland Fed's inflation nowcasting model, which has historically been very accurate, they expect February's CPI data to come in at 2.83% year-over-year increase in the headline number and a 3.16% year-over-year increase in the core CPI number, both again lower than January's year-over-year readings. That'll give the market some hope, some optimism that inflation really isn't running away from us. Now, you can start to look at March's estimates here and see that, again, it's going to be even lower. Like the headline CPI number for the month-over-month percent change in March is only expected to be 0.01%. That's not indicative of a structural inflationary problem. And you can see that moving forward, inflationary data should really start to improve from here. And also, as that trade imbalance, that rubber banded, that expanded, contracts in coming months, Trump's now our president. He's been inaugurated. There's no more front-running tariffs with imports. All of this stuff is going to start to offset the bad January data as we start to get February's data and March's data, which we're now starting to get this week and next week and in the weeks to come. So there's reason to be optimistic about the economy and the direction of inflation right now. We can even look at Trueflation, which again has historically been pretty accurate. They think that right now, the U.S. inflation rate is 1.35%, and it's been falling off a cliff since December of last year. And it's just another thing to give you some hope and some optimism, despite what everybody out there in the markets are saying. But the reason they're freaked out about inflation is not only because it's been on the uptrend since the Fed first cut interest rates, it's also because of Trump's tariffs. They're worried that tariffs are going to cause an increase in consumer prices, which is a possibility. It's possible that consumers will have a one-time increase in the prices they pay for the goods and services that they demand. That is possible. But again, what the markets don't realize is we have data we can go back and look at from Trump's first presidency during his first round of tariffs, and we can see that there was actually zero increase in consumer prices as a result of those tariffs that were implemented. Inflation actually downtrended and was below the Fed's 2.0% target as these tariffs were being implemented. So there's zero evidence out there right now to show us that tariffs at the end of the day are going to make consumers have to pay more for the goods and services that they want. And why is that? Well, it's because our economy encourages competition. If we have two different businesses and one of those businesses passes on the extra cost of the tariff to the consumer and makes the consumer pay more, that business is going to lose all of those consumers to the business that chooses not to pass on the extra cost to the consumer and instead chooses to eat it in their own profit margins. That's why the S&P 500 fell in 2018 and 2019. It's because profit margins got hit as a result of the tariffs, not because of inflation. And again, even if we do have a one-time bump in consumer inflation, that is not indicative of a structural inflationary problem in our economy. And if you would look at profit margins of companies in the S&P 500 today, they're at record highs, and profit margins have been expanding since the early 1990s. So now more than ever, our corporations have the ability to eat any additional costs in their profit margins, which again is why, at the end of the day, consumers very rarely, at least in the data, have had to pay more for the goods and services that they want. Now, I know the real savvy bears out there would point to a chart like this to try and disprove what I just said, where via the manufacturing and non-manufacturing PMI data, prices paid for goods and services producers have been going up. But again, we can look at 2018 and 2019 and see the same thing happen, where prices paid for raw materials went up. But again, in the inflation data via the consumer, it's not reflected at all because these corporations, these businesses ate the extra costs in their profit margins. So seeing prices paid go up in this data, yeah, it can be somewhat concerning. It's something to keep an eye on. But if we look at historical data, this just happened, 6-7 years ago? This really isn't something to be that concerned with, at least yet. And another thing we need to consider here is, I know Trump's talking a big game about how some short-term pain will be necessary. I agree with him, actually. I think short-term pain will be needed for long-term gain, but that is a very, very tough argument to sell to the American consumer, to the American citizen. They don't want to deal with short-term pain for long-term gain. They don't have the patience. They might not have the time to deal with that. That's a very, very tough sell for the president to make long term. And you know what? Midterm elections are going to come up sooner than you think. And those races are going to start sooner than you think. And Trump can absolutely not afford to lose ground in the midterms if he wants to accomplish everything he wants to accomplish. So that means that he can't continue to be rough on the short-term outlook. Otherwise, he's going to lose followers. He's going to lose voters when it comes to the midterms. Politically, it makes no sense for this to continue for the next year and a half. Politically, it makes sense for this to continue maybe another month or two till we get to the summer months. I'm not saying there's nothing to worry about right now. I'm not saying there's nothing that we need to keep our eye on. But when we look at the real data and we really look into the data we're given, we can see that January's import data, all of January's economic data was swayed by one-term aberrations, whether that was from imports, whether that's from consumer spending, whether that's from colder weather impacting that consumer spending, whether that's inflation running hot because of those annual price increases that occur every January of every year. I don't know. All I know is it's an outlier. And I believe as we get February and March's data, we're going to get stronger than expected economic data, and we're going to get lower than expected inflation data. And all of a sudden, this stagflationary concern in the markets right now is going to disappear. You know what happens when the biggest fear in the markets just disappears? The bulls have a field day. So right now, there are so many great companies with strong balance sheets in industries that are the fastest growing industries in the world right now that have seen their valuations get cut by 40% or more in just a handful of trading days. And that's where the opportunity is found. The market's mistakenly selling off those investments. It's really the bulls at the end of the day that are going to take advantage of that and make millions of dollars. This is when life-changing money is made. It's not made, during a raging bull market where new record highs are set day after day after day. You see, most people want to buy stocks when stocks are going up, and they want to sell stocks when stocks are going down. But that is a losing mindset. I'm telling you, that is a losing mindset. And you will never succeed in the markets if that is your game plan. So this sort of valuation reset that we've seen has actually been much needed, in my opinion. And it's presenting a great buying opportunity in so many strong businesses. I've talked about many of them on my YouTube channel. If you want, more of my stock picks, in my opinion, on companies that are trading in extreme discounts right now, and you can support my buying addiction in the stock market, check out that membership. You get access to the members Discord server, a bunch of other perks. Just check it out. Hit the join button located right next to the subscribe button, or hit the Patreon link in the pinned comment. The membership's been growing like crazy. This YouTube channel's been growing like crazy. I can't thank you guys enough for it. But this valuation reset is a big deal because, looking into 2025 and 2026, I was getting concerned. That's why I placed hedges on the market. I actually short sold the Magnificent Seven, and I short sold Palantir like on January 27th. That proved to be a great plan. Now I took profits on that way too early, so that's another conversation. But when I was looking into 2025 and 2026, I was concerned because the only way to see stock prices rise was via earnings expansion. There was very little room for valuation multiples to expand from where they were. But now all of a sudden, in just a handful of weeks, valuations have started to get crushed, which means along with earnings expansion, we can have multiple expansion. Both of those avenues are avenues that, they could even work together and lead to stock prices rising over the near term and over the long term. So to summarize all of this, I think some relief will be found tomorrow. Again, I don't have a crystal ball. I'm kind of risking looking like an idiot by putting this video out today, the day before we get CPI data. So I'm praying it'll go my way. But I don't see the concern that the markets are seeing right now. I just don't think the long-term playbook is going to, I don't think the long-term game is going to play out how the markets think it will right now. And if you would disagree with that or see holes in my thesis here, please let me know down in the comment section. I love having these conversations. I think it makes everybody smarter. It helps everybody out at the end of the day. I think long-term markets are fine. And, if the markets want to keep falling, I'm gonna keep buying stocks. I'm gonna keep increasing my exposure to companies that I love at even cheaper valuations. Long term, I'm ecstatic when this stuff happens. I live for moments like this, so I actually hope it continues. But again, I don't think it will. We're going to start to get some relief tomorrow, in my personal opinion. It's going to be bumpy until the summer months, at least the summer months, in my opinion. But the worst of the worst, in my opinion, I can't say that enough, is probably behind us at this point. Now, if you guys are new here or turning not yet subscribed, please subscribe down below. I love seeing all the new faces pop into the YouTube channel. I hope you have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.